Advanced Taxation, Chapter 6, Ascertainment of Tax Liabilities. Content: 1. Purpose. 2. Introduction. 3. Imposition. 4. Trade or business. 5. Dividends. 6. Authorized unit trust scheme. 7. Exemptions. 8. Determination of profits. 9. Allowable deductions. 10. Disallowable expenditure. 11. Waiver or refund of liability or expense. 12. Basis of assessment. 13. Company in partnership with another. 14. Total profit and sources of profit. 15. Losses. 16. Normal company tax rate. 17. Tertiary education tax. 18. Small business rate. 19. Pre-operation levy. 20. Information technology tax. 21. Withholding tax. 22. Capital allowances. 23. Deferred taxation. 24. Chapter review. 25. Worked examples. Ascertainment of tax liability. Purpose. After studying this chapter, readers should be able to A. Know the various profits or incomes that are taxable or exempted from companies' income tax under Companies Income Tax Act. B. Understand the principles of allowable and disallowable deductions as applicable to companies chargeable to tax under CETA. C. Know how basis period of assessment is to be determined. D. Know how to aggregate income from all sources to arrive at total profit. E. Know the provisions of CETA with regards to loss relief. F. Be able to prepare applicable assessable profit computation applying the provision of CETA to new trade, ongoing trade, cessation of trade, and change of accounting date. G. Understand the provisions of the second schedule to CETA dealing with capital allowances. H. Know the classification of qualified capital expenditure. Know the classification of qualifying capital expenditure and the applicable capital allowances. I. Know the conditions stipulated in the Act for the granting of capital allowance to companies and how the allowances are granted. J. Understand how basis period for capital allowance computation is determined. K. Prepare capital allowances computation in line with the applicable provisions of CETA. L. Know the roles of agents in withholding tax collection. M. Identify various transactions that attract withholding tax. N. Determine payment due to either FIRS or SIRS, and O. Be conversant with payment schedules and the various rates in use. Introduction. Companies' income tax is chargeable on the income of all companies operating in the country except those specifically exempted under the Act. There is a clear distinction between Nigerian and non-Nigerian companies. A Nigerian company is defined as one incorporated under the Companies and Allied Matters Act, CAMA 2004, as amended. The total profits of such companies are accessible to Nigerian tax, irrespective of whether or not all the profits have been derived from, brought into, or received in Nigeria. A foreign company, that is non-Nigerian company, is defined as any company or corporation established by or under any law in force in any territory or country outside Nigeria. That is, a company that is not incorporated under CAMA. The profit of a non-Nigerian company shall be subject to Nigerian tax only to the extent to which such profits are attributable to the company's operation in Nigeria, subject to provisions in the respective double taxation agreements, if any, available within the country where the foreign company is registered. Withholding tax of 10% is deductible from dividends, interest, or royalty due to non-Nigerian companies arising in Nigeria. In short, companies' income tax is chargeable on A. The global profit of Nigerian companies, irrespective of whether or not they are brought into or received in Nigeria. Dividend income to a Nigerian company is treated as franked investment income on which no income tax is due. B. The portion of the profit of non-Nigerian companies derived from such companies' operation in Nigeria. C. Dividends, interest, or royalties due to non-Nigerian companies, which are assessed at 10%, that is withholding tax rate, on the gross amount due, and only the net is payable to the respective companies. Subtopic: Imposition. Section 8 of Companies Income Tax Act (CITA) imposes tax at a particular rate, currently 30%, upon the profit of any company accruing in, derived from, brought into, or received in Nigeria in respect of A. Any trade or business, B. Rent or any premium arising from a right granted to any other person for the use or occupation of any property. The treatment of rental income for companies' income tax purposes is the same as that for personal income tax. C. Dividends, interest, royalties, discounts, charges, or annuities. D. Any source of annual profits or gains not falling within the preceding categories. E. Any amount deemed to be income or profit under a provision of the Act, or with respect to any benefit arising from a pension or provident fund of the Personal Income Tax Act. F. Fees, dues, and allowances wherever paid for services rendered. Any company entering into any agreement, whether oral or written, in respect of any service in this regard is required by the Act to make full disclosure in writing to the Revenue Service of the terms of such agreements. And G. Any amount of profit or gains arising from acquisition and disposal of short-term money instruments like federal government securities, treasury bills, treasury or savings certificates, debenture certificates, or treasury bonds. Subtopic: Identification of a company. The incorporation number of a company and the tax identification number (TIN) generated by FIRS, to which the provisions of Section 8 apply, shall serve as the identification number of the company and shall be displayed by the company on all business transactions with other companies and individuals and on every document, statement, returns, audited accounts, and correspondence with revenue authorities, including the Department of Customs and Excise, ministries, and all government agencies. Where profits are accrued, CITA Section 11. The profit of a Nigerian company shall be deemed to accrue in Nigeria wherever they have arisen and irrespective of their being brought into or received in Nigeria. The profit of a company other than a Nigerian company from any trade or business shall be deemed to be derived from Nigeria. A. If that company has a fixed base of business in Nigeria, to the extent that the profit is attributable to the fixed base. B. If it does not have such a fixed base in Nigeria, but habitually operates a trade or business through a person in Nigeria, authorized to conclude contracts on its behalf or on behalf of some other companies controlled by it, or which have controlling interest in it, or habitually maintains a stock of goods or merchandise in Nigeria from which deliveries are regularly made by a person on behalf of the company, to the extent that the profits are attributable to the business or trade or activities carried on through that person. C. If that trade or business or activity involves a single contract for surveys, deliveries, installation or construction, the profit from that contract, and D, where the trade or business or activity is between the company and another person controlled by it, or which has controlling interest in it, and conditions are made or imposed between the company and such person in their commercial or financial relations, which in the opinion of the Revenue Service is deemed to be artificial or fictitious. So much of the profit adjusted by the Revenue Service to reflect arm's length transactions. For the purpose of subsection 2A of this section, a fixed base shall not include A. Facilities used solely for storage or display of goods or merchandise, and B. Facilities used solely for the collection of information. Subtopic: Trade or business. Companies are normally formed to carry out particular activities which will be specified in the object clause of their respective memorandum of association. Therefore, in determining what constitutes a trade or business of a company, it is necessary to refer to the object clause of its memorandum of association to ascertain the activities that the company was registered to carry out. The carrying on of such activities will definitely constitute trade or business, and the income therefrom will be subject to companies' taxation in accordance with the provisions of the Act. Thus, a trade or business will include manufacturing and any other activities being carried on in pursuance of the goal for which the company was incorporated. Furthermore, in view of the fact that a company will pursue all possible activities to keep it in business, it is only reasonable to conclude that the income from all such activities constitutes chargeable transactions and will therefore be taxed, except if they relate to capital items or are specifically exempted by other provisions of the Act. Neither the absence of a profit-making motive in particular transaction nor the fact that they are isolated and do not relate to the company's normal business could prevent the income from such transactions from being subjected to company's taxation. Subtopic: Dividends. Tax is imposed on dividend income in Section 8 of CETA. The definition of dividend is given in subsection 3 of Section 8 of the Act is as follows. A. In relation to a company not being in the process of being wound up or liquidated, any profit distributed, whether such profits are of a capital nature or not, including an amount equal to the nominal value of bonus shares, debentures, or securities awarded to the shareholders, and B. In relation to a company that is being wound up or liquidated, any profits distributed, whether in money or money's worth, or otherwise, other than those of a capital nature earned before or during the winding up or liquidation. As in the taxation of individuals, the amount to be taken as the income of a company is the gross amount of the dividend and is deemed to arise on the day on which its payment becomes due. The provision of Section 15 CETA exempts certain dividends from tax. These are dividends 1. By a Nigerian company and satisfied by the issue of shares of the company paying the dividend, that is bonus shares, or 2. By a Nigerian company out of any profit exempted from tax by any provision of the Act or by the fact that the company enjoys a pioneer status, or 3. Out of any profit chargeable to tax under the provision of the Petroleum Profit Tax Act. Part of the 1985 amendment to the Act is to the effect that dividends received from a Nigerian company are to be regarded as franked investment income (FII). The 1987 amendment also exempts from tax dividend derived by a company from another company incorporated in Nigeria, provided that the equity participation on which the dividend is payable, either wholly paid for in foreign currency or by assets brought into or imported into Nigeria, between 1 January 1987 and 31 December 1992, not less than 10% of the equity share capital of the company paying the dividend. For the purpose of this exemption, the tax-free period starting from the year following that in which the new capital is brought into Nigeria shall be 5 years. If the company is in the agricultural trade or business, or is engaged in the petrochemical or liquefied natural gas business, it shall be 3 years in any other case. The amount of the withholding tax deducted in connection with any dividend due to a non-resident recipient shall be the final tax on those payments. That is, no further tax is payable by non-resident recipients of any dividend income. Payment of dividend by a Nigerian company. Where a dividend is paid out as profit on which no tax is payable due to A. No total profit, or B. Total profits which are less than the amount of dividend which is paid. Whether or not the recipient of the dividend is a Nigerian company, is paid by a Nigerian company, the company paying the dividend shall be charged to tax at the rate prescribed in subsection 1 of section 40 of this Act, as if the dividend is the total profit of the company for the year of assessment to which the account out of which dividend is declared relates. Nigerian dividend received by companies other than Nigerian companies. In the case of a company which is neither a Nigerian company nor engaged in a trade or business in Nigeria at any time during a year of assessment, A. No tax shall be charged on it for that year in respect of any dividend received by it from a Nigerian company, apart from tax withheld under section 80 of this Act. B. Where any dividend is paid out of profit on which no tax is payable due to no total profit or total profits which are less than the amount of the dividend which is paid, whether the recipient of the dividend is a Nigerian company or not, the company paying the dividend shall be charged to tax at the rate prescribed in subsection 1 of section 40 of this Act, as if such dividend is the total profit of the company for the year of assessment, which relates to account out of which the dividend is declared. C. Nothing in this Act shall confer on such company or on the company paying the dividend a right to repayment of tax paid by reason of the provisions of this section. Illustration 6.1. A company with total profit of 140,000 naira for 2014 assessment year paid 250,000 naira dividend to its shareholders in respect of the 2013 financial statement, which formed the basis for the assessment. The company will pay tax of 75,000 naira, that is 30% of 250,000 naira, assuming its turnover is more than 500,000 naira, and not 42,000 naira, which is 30% of 140,000 naira, which would have been payable if the company did not declare the dividend. Subtopic: Authorized Unit Trust Scheme. The provisions relating to unit trust schemes are contained in section 14A. The provisions of CETA shall, in respect of the income arising to the trustees of an authorized unit trust, have effect as if A. The trustees were an investment company, B. The right of the unit holders were shares in the company, and C. any income accruing to the trustees available to be paid to the unit holder were dividends on such shares. The profit of an unauthorized unit trust scheme on which tax may be imposed shall be the income accruing to the trustees from all sources of the investment of the unit trust, and deducting therefrom sums disbursed as management expenses, including remuneration for the managers. The treatment of tax deducted at source is the same as is applicable to any other company taxable under CETA. In this section, authorized unit trust is defined as a unit trust scheme that is authorized by the Commission under Section 576 of the Companies and Allied Matters Act 2004 as amended to carry on the business of dealing in unit trust scheme. Unit trust scheme is defined as any arrangement made for the purpose of providing facilities for the participation of the public as beneficiaries under a trust in profit or income arising from the acquisition, holding, management, or disposal of securities or any other property whatsoever. Unit holder is defined as any investor, beneficiary, or person who acquired units in a unit trust scheme and who is entitled to a share of the investment subject to the trust of a unit trust scheme. A trustee is defined as the person in whom the property for the time being subject to any trust created in pursuance of the scheme is or may be invested in accordance with the terms of the trust. Subtopic Exemptions. Section 19 of CETA contains the list of profits or gains of companies or corporate bodies exempted from company taxation. A. Profit or income exempted insofar as they are not derived from trade or business being carried on. 1. The profit of any company being a statutory or registered friendly society. 2. The profit of any company engaged in ecclesiastical, charitable, or educational activities of a public character. 3. The profit of any company being a trade union registered under the Trade Union Act. 4. The profit of any company or corporation established by the law of a state for the purpose of fostering the economic development of that state. 5. The profit of any company being a cooperative society registered under any enactment or law relating to cooperative society, not being profit from any trade or business carried on by that company, other than cooperative activities solely carried out with its members or from any share or other interest possessed by that company in a trade or business in Nigeria carried on by some other person or authority. If any income in respect of the foregoing is derived from a trade or business, it is clear from the wordings of Section 19 that such shall become taxable. B. The following are also exempted from tax even if they are derived from trade or business being carried on by the bodies concerned. 1. The profit of any company formed for the purpose of promoting sporting activities, where such profits are wholly expendable for such purpose, subject to such condition as the Revenue Service may describe. 2. Dividend distributed by a unit trust. 3. Dividend derived by a company from another company incorporated in Nigeria, provided that the equity participation of the recipient of the dividend in the company paying the dividend is either wholly paid for in foreign currency or by assets brought or imported into Nigeria between 1st of January 1987 and 31 December 1992, and the company receiving the dividend is the beneficial owner of not less than 10% of the equity share capital of the company paying the dividend. The dividend tax-free period shall commence from the year of assessment following the year in which the new capital is brought into Nigeria for the purpose of the trade or business in Nigeria of the company paying the dividend. If the company paying the dividend is in the agricultural trade or business, or is engaged in the petrochemical or liquefied natural gas, the tax-free period shall be 5 years, while in any other case, it is limited to 3 years. 4. The profits of any company engaged in petroleum operations within the meaning of Section 2 of the Petroleum Profits Tax Act, insofar as those profits are derived from such operation and liable to tax under that act. It should be noted that if any part of the profits of such company arises from other operations besides petroleum exploration, development and production, and can therefore not be taxed under the Petroleum Profits Tax Act, such part is taxable under the Companies Income Tax Act. 5. The profit of any company being a body corporate established by or under any local government law or edict in force in any state in Nigeria. 6. The profit of any body corporate being a purchasing authority established by an enactment and empowered to acquire any commodity for export from Nigeria as well as from the purchase and sale of that commodity. 7. The profit of non-Nigerian companies which, but for this paragraph, would be chargeable to tax by reason solely for their being brought into or received in Nigeria. 8. Dividend, interest, rent, or royalty derived by a company from a country outside Nigeria and brought into Nigeria through government-approved channels. Government-approved channels means the Central Bank of Nigeria, any bank or other corporate bodies appointed by the minister as authorized dealer under the second-tier Foreign Exchange Market Act or any enactment replacing that act. 9. The interest on deposit accounts of a foreign non-resident company, provided that the deposits into the accounts are transfers wholly of foreign currencies to Nigeria on or after 1 January 1990 through government-approved channel. 10. The interest on foreign currency domiciliary accounts in Nigeria accruing on or after 1 January 1990. 11. Dividend received from small companies in the manufacturing sector in the first 5 years of their operation. Small companies are companies with turnover of 1 million and below in an assessment year. 12. Dividend received from investment in wholly export-oriented business. 13. The profits of any Nigerian company in respect of goods exported from Nigeria, provided that the proceeds from such exports are repatriated to Nigeria and are used exclusively for the purchase of raw materials, plant, equipment, and spare parts. 14. The profit of a company whose supplies are exclusively inputs to the manufacturing of products for export, provided that the exporter shall give a certificate of purchase of the input of the exportable goods to the seller of the supplies. In respect of all the foregoing, appropriate withholding taxes are deductible in accordance with the provision of Section 60, 61, 62 of CETA, in spite of the fact of the exemption of the gains or profits from income tax. The National Council of Ministers, that is Federal Executive Council, may exempt by order any company or class of companies from all or any of the provision of the Act, or all or any profits of any company or class of companies from any source on any ground which appears to it sufficient. The National Council of Ministers may, by order, amend, add to, or repeal any exemption insofar as it affects a company. The following notices and orders shall continue in force for all purposes of the Act. A. The income exemption, that is interest on Nigerian public loans, notice. B. The income tax exemption order, that's for the Nigerian Broadcasting Corporation. C. The railway loan, that is International Bank, exemption of interest, notice. Interest on loan, agricultural trade and others. Interest payable on any loan granted by a bank on or after 1 January 1991 for the purpose of an agricultural trade or business shall be exempted from tax, provided that the moratorium is not less than 18 months and the rate of interest on the loan is not more than the base lending rate at the time the loan was obtained. With effect from 1 January 1991, the requirements are: 1. The moratorium is not to be less than 18 months, and 2. The rate of interest on the loan is not to be more than the base lending rate at the time the loan was obtained. Base lending rate means the weighted average of the cost of funds to any bank. Agricultural trade or business is defined in the Act as any trade or business connected with A. The establishment or management of plantation for the production of rubber, oil palm, coffee, tea, and similar crops. B. The cultivation or production of cereal crops, tubers, fruits of all kinds, cotton, beans, groundnuts, shea nuts, beniseed, vegetables, pineapples, bananas, and plantains. C. Animal husbandry, that is to say, poultry, piggery, cattle rearing, fish farming, and deep sea fish trawling. Act 18 of 1998. Subsection 7 of Section 8 of the Act has been replaced with a new subsection 7 in Act 18 of 1998. The new subsection 7 is as follows. Interest on any loan granted by a bank on or after 1 January 1997 to a company A. engaged in agricultural trades or business, or the fabrication of any local plant and machinery, or B. as working capital for any cottage industry established by the company under the Family Economic Advancement Program (FEP), shall be exempted from tax, provided 1. The moratorium is not less than 18 months, and 2. The rate of interest on the loan is not more than the base lending rates at the time the loan was granted. Thus, the provision relating to the loan granted to the agricultural trade or business on or after 1 January 1991 are, with effect from 1 January 1997, extended to the trade or fabrication of local plants and machinery, as well as Family Economic Advancement Program (FEP) cottage industry. Interest on loan for export business. Interest accruing from loans granted by banks in aid of export activities is exempted from tax in accordance with the table in Schedule 3 to the Act. The table, which is the table of tax exemption on interest on foreign and other loan, is reproduced below. Table of tax exemption on interest on foreign and other loans. Repayment period including moratorium. Grace period. Percentage exemption allowed. 1. Above 7 years, the grace period is not less than 2 years, while the tax exemption allowed is 100%. When the repayment period is 5 to 7 years, the grace period is not less than 18 months and the tax exemption allowed is 70%. When the repayment period, including moratorium, is between 2 to 4 years, the grace period is not less than 12 months and the tax exemption allowed is 40%. When the repayment period, including moratorium, is below 2 years, the grace period is nil and the tax exemption allowed is nil. The exemption is subject to the presentation of a certificate issued by the Nigerian Export Promotion Council stating that not less than 50% of a company's manufactured goods sold in the relevant accounting year were sold outside Nigeria and were not re-exported into Nigeria. Subtopic: Determination of profit. For tax purposes, use is made of the accounts produced under the ordinary rules of accountancy, as it will be extremely difficult, if not possible, to prepare new set of accounts for tax purposes only. Besides the difficulties anticipated, there appears to be no justification for the unnecessary duplication of the effort that would be required in the production of such accounts. It has been established in some decided cases that in ascertaining the true profit of a trade for tax purposes, regard should be had to the correct principles of accountancy. Thus, in practice, adjustments that are considered necessary in view of the provision of the Tax Act are made to accounting profits to arrive at the profit for tax purposes. Such adjustments are usually in respect of a. Expenditure charged but not allowable, that is, disallowable expenditure. B. Items chargeable to tax but not credited in the statement of comprehensive income. C. Items credited in the statement of comprehensive income but not taxable. And D. Expenditure not charged but allowable. There are adequate provisions in the Act which, when considered in the light of normal taxation practice, can be applied to determine which items of a company's trading transaction will fall into any of the 4 categories listed above and for which adjustment will be necessary. The main guiding principle is that of allowable and disallowable expenditure. Subtopic: Allowable deductions. All expenditures of a company that are wholly, exclusively, necessarily, and reasonably incurred in the production of the profit are allowable deductions. Thus, any expenditure that can be proved to meet these conditions will be an allowable deduction in arriving at a company's chargeable profit, unless such expense is specifically prohibited under any other provision of the Act. In addition, the following items are stated in Section 20 of the Act as allowable deductions, provided they are incurred for the purpose of acquiring the profits being subjected to tax. A. Interest on money borrowed and employed as capital. B. Rent and premiums in respect of land or buildings occupied for the purpose of acquiring the profits. C. Repairs and renewal costs relating to the premises, plants, fixtures, etc. used in the business. D. Bad and doubtful debts to the extent that they are respectively estimated to the satisfaction of the revenue service to have become bad or doubtful of collection. E. Contributions to approved pension. Contributions to approved pension, provident or other retirement benefits fund, society or scheme. F. In the case of the Nigerian Railway Corporation, such deductions are allowed under the provision of the authorized deductions. Nigerian Railway Corporation Rules 1959. G. Any outlay or expenses incurred during the year in respect of 1. Salaries, wages, or other remuneration paid to employees. 2. Costs to the company of any benefit or allowance provided for the senior staff and executive, which shall not exceed the limit of the amounts prescribed by the collective agreement between the company and the employees and approved by the Federal Ministry of Employment, Labor and Productivity, and the Productivity, Prices and Income Revenue Service, as the case may be. And 3. The expenses proved to the satisfaction of the revenue service to have been incurred by the company in research and development for the period, including the amount of levy paid by it to the National Science and Technology Fund. H. Section 22 allows for the deduction of the amount of reserve made out of profits for research and development, subject to a ceiling of 10% of the total profit of the company before any deduction is made under this section and Section 21 of the Act. I. Companies and other organizations engaged in research and development activities for commercialization shall be allowed 20% investment tax credit on their qualifying expenditure for that purpose. Rental charges. Rental charges in respect of residential accommodation occupied by employees of the company are allowed up to a maximum of 100% of the basic salary of employees. Property holding companies. The allowable deductions are limited to A. Expenses attributable to the maintenance of the property concerned, and B. Directors' remuneration of up to 10,000 naira per annum per director, payable to a maximum of 3 directors in any company. Subtopic: Repair and renewals. The usual items under this heading are those expenses incurred in maintaining the earnings capacity of the assets of the company intact. In view of the fact that the keeping of such assets in good working condition is very essential for the company to acquire profits, costs connected with such exercise must, by reasonable expectation, be allowable deductions. However, costs incurred in increasing the earning capacity of any fixed asset are capital in nature and therefore will be allowable deductions. Repair expenditure on newly acquired fixed assets might not qualify as an allowable deduction, particularly if large amount is involved and the expenditure is incurred to bring the asset into a usable condition after its acquisition. Such cost is to be considered as capital and should be added to the cost of acquisition of the asset. It is important to take note that repair costs are incurred for the purpose of maintaining the earning capacity of the asset, and this implies that such assets must be in use in the business at the time that the repair work is carried out. Subtopic: Bad and doubtful debts. The salient matters to note with regard to the treatment of bad and doubtful debts for tax purposes are as follows. A. They must relate to debts incurred in the ordinary course of the trade or business. B. They must be identifiable to specific debts. General reserves against bad and doubtful debts are not allowable deductions. C. Reserves no longer required are taxable in the year that they are considered no longer necessary if previously allowed. D. Debt previously written off, allowed in tax computation, and later recovered are taxable as income for the year in which recoveries are made. E. Necessary evidence must be provided at the request of the Revenue Service to prove that the debts have become bad or estimated to be doubtful of recovery. Illustration 6.2. The bad and doubtful debt account of a company for a year showed the following. On debit side, we have the trade debt written down, 13,000. Reserves carried forward, specific 22,000. General 15,000, totaling 50,000. On the credit side, reserves brought forward, specific 20,000. General 16,000. Charge to profit or loss account is 14,000, totaling 15,000. In the statement of comprehensive income of this company, the sum of 14,000 will be shown as the charge to bad and doubtful debt for the year. How this sum has been arrived at can be reproduced in statement form as follows. Trade debt written of 13,000. Add increase in specific provision, that is 22,000 minus 20,000, giving 2,000. 13,000 plus 2,000 is 15,000. Less reduction in general provision, which is 16,000 minus 15,000, which gives 1,000. 15,000 minus 1,000 is 14,000. So 14,000 is charged to profits and loss account. It will be easier from this statement to determine which amount should be adjusted for in the tax computation in respect of this company, in respect of this company's bad and doubtful debt charge as follows. A. This will be an allowable charge as the amount written off is in respect of specific debt. B. The increase will also be allowable as the amount involved is also in respect of specific debt. C. The general provision would have previously been disallowed when created. Any subsequent release of this sort of provision cannot be taxable as it had never been allowed. Thus, the accounting profit will be reduced by the amount of the reduction in the general provision, resulting in a lower taxable profit than the accounting profit. The only adjustment necessary in respect of the foregoing is a deduction of the sum of 1,000 naira in respect of C above from the accounting profit to arrive at the taxable profit of the company. Thus, if a specific reserve for bad debt increases or decreases, no adjustment is necessary to the accounting profit. But in case of general reserve, appropriate adjustment will need to be put through. Subtopic Donations. CETA Section 21 stipulates, among other things, the conditions to be satisfied before any donation can be allowed. These are: A. Donation must be made out of the profit of the company. Thus, if a company makes a loss, whatever donation paid during that year should not be treated as allowable. B. Donations should not be expenditure of a capital nature. C. For any year of assessment, the maximum amount allowable is limited to 10% of the total profit of the company before deducting the donation. D. The donation must be made to any of the approved bodies. Note: following the provision of the company's income tax, donation, whether of a revenue or capital nature, made in respect of university and other tertiary or research institution for research or any developmental purpose, or as an endowment out of the profit of the period by a company, shall not exceed an amount which is equal to 15% of the total profits, of 25% of the tax payable in the year of the donation, whichever is higher. The fifth schedule of CETA, which contains the list of the approved bodies, etc., to which donation may be made, is reproduced below with necessary grouping to facilitate commitment to memory by readers. Donation to any body or institution whose name is not included on the list will not be allowable deductions. Fifth schedule, section 21. Funds, bodies, and institutions in Nigeria to which donations may be made under section 31 of the Act are youth of philanthropic organizations. A. The Boys Brigade of Nigeria. B. The Boy Scouts of Nigeria. C. The Girls Guides of Nigeria. D. The Nigerian Red Cross. E. The National Youth Council of Nigeria. F. The Nigerian Youth Trust. Religious. A. The Christian Council of Nigeria. C. Islamic Education Trust. Medical. Any hospital owned by the government of the Federation or of a state, or any university teaching hospital, or any hospital which is carried on by society or association otherwise than for the purpose of profit or gains, to the individual members of that society or association. Educational. A. Any educational institution affiliated under any law with any university in Nigeria or established under any law in Nigeria, and any other educational institution recognized by any government in Nigeria. B. The Institute of Medical Laboratory Technology. C. The National Library. D. A public fund established and maintained exclusively for providing money for the acquisition, construction, maintenance, or equipping a building used or to be used as a school or college by the government of the Federation, or a state, or by a public authority, or by a society or association which is carried on otherwise than for the purpose of profit or gain, to the individual members of that society or association. E. The National Braille Library of Nigeria. F. Van Leer Nigerian Education Trust. G. The Institute of Chartered Accountants of Nigeria Building Fund. The Institute of Chartered Accountants of Nigeria Building Fund. H. Nigerian Accounting Standard Revenue Service. I. Peterson Zekoni's Nigeria Technical Education Trust Fund. J. Educational Cooperative Society. Relief Funds. A. National Commission for Rehabilitation. B. A public fund established and maintained for providing money for the construction or maintenance of a public memorial relating to the Civil War in Nigeria, which ended on 15 January 1970. C. Southern Africa Relief Fund. D. Any public fund established or approved by the government of the Federation or any of the state governments in aid of or for the relief of droughts or any other national disaster in any part of the Federation. Research. A. The Cocoa Research Institute of Nigeria. B. The National Council for Medical Research. C. The National Science and Technology Development Agency. D. The Nigerian Institute for International Affairs. E. The Nigerian Institute for Oil Palm Research. F. The Nigerian Institute for Trypanosomiasis Research. G. National Science and Technology Fund. Welfare. A. A public institution or public fund, including the Armed Forces Comfort Fund, established or maintained for the comfort, recreation, or welfare of members of the Nigerian Army, Navy, or Air Force. B. National Sports Commission and its state associations. C. The Nigerian Society for the Deaf and Dumb. D. The Society for the Blind. E. The Nigerian National Advisory Council for the Blind. F. Association or societies for the blind in Nigeria. G. Training center and residence schools for the blind in Nigeria. H. Rotary International, that is Polio Plus program. I. The Musical Society of Nigeria. Foundations or Endowment Fund. A. Kewaram Chanrai Foundation Limited. B. Half-Print Foundation Limited. C. University College Hospital Endowment Fund. Others. A. The Nigerian Museum. B. Nigerian Conservation Fund. References to donation made by a company do not include any payments made by the company for valuable consideration. Research and development. The allowability of amounts relating to research and development are in two sections of the Act. Section 20 G3 allows expenses proved to the satisfaction of the revenue service to have been incurred by the company in research and development for the period including the amount of levy paid by it to the National Science and Technology Fund. Section 22 allows the deduction of amounts of reserves made out of the profit of that period by a company for research and development. The deduction to be allowed under this section for any year of assessment shall not exceed 10% of the total profit of the company for that year as ascertained before any deduction is made under this section and section 21, that is deductible donations of the Act. The effect of these two sections can be summarized first. A. Actual expenditure on research and development are allowable deduction in accordance with the provision of section 20. B. Reserve made out of profit for research and development expenditure are allowed as a deduction from profit subject to the ceiling fixed. One thing to be noted though is that a company cannot make the deduction twice. If the deduction was made when the reserve was made, such cannot be deducted again when the actual expenditure is incurred. In addition, subsection 3 of section 22 provides for 20% investment tax credit on the qualifying expenditure of companies and other organizations engaged in research and development activities for commercialization once the expenditure are incurred for that purpose. Subtopic: Disallowable expenditure. Certain expenditures are disallowable for tax purposes. These are specifically listed in section 23 of the Act and they should be added back to accounting profits even if their charge in the profit and loss accounts could be justified under ordinary rule of commercial accountancy. These are A. Capital repaid or withdrawn and any expenditure of a capital nature. B. Any sum recoverable under an insurance or contract of indemnity. C. Taxes on income or profits levied in Nigeria or elsewhere. In case of tax levied outside Nigeria on profits, which are also chargeable to tax in Nigeria, and double taxation relief is not available, such tax will be an allowable deduction. D. Payment to unapproved pension, provident, savings or widows and orphan society funds or schemes. E. Depreciation of any asset. Capital allowances are granted instead. F. All appropriations for profit, namely dividend, general provision for bad and doubtful debts, write-off of preliminary and formation expenses, and expenses on issue or redemption of shares and other securities, etc. Pre-production expenses, to the extent to which they are not of capital nature, will be allowable deduction, as such have been incurred for the purpose of producing the company's profit. G. Any expense of any description incurred within or outside Nigeria for the purpose of any management fee, unless prior approval of an agreement giving rise to such management fee has been obtained from the minister. H. Any expense whatsoever incurred within or outside Nigeria as management fee under any agreement entered into after the commencement of this section, except to the extent as the minister may allow. And I. Any expense of any description incurred outside Nigeria for and on behalf of any company except of a nature and to the extent as the Revenue Service may consider allowable. Treatment of asset impairment. The present tax laws have not been amended to consider issues relating to the treatment of impairment of receivables, tangibles and intangible assets with respect to International Financial Reporting Standards (IFRS). Therefore, the debit to statement of comprehensive income is not yet allowable for tax purposes as it is not yet consumed. All impairment losses under IAS 36 charged to the SCI should not be allowed for tax purpose. Subtopic: Waiver or refund of liability or expense. Where the liability for an allowed expense is subsequently waived or released, or a refund is received for the amount paid, the amount which is so waived, released, or refunded is deemed to be the income of the company in the year in which the waiver, release, or a refund is made or given. Similar provision is applicable in personal taxation practice. It should be noted that where a waiver of a non-revenue item, for example, a loan, is in the favor of a company, such an amount shall only be subjected to capital gain tax, if applicable, not income tax, as the liability had not been previously treated as an allowed expense. If no CGT is due, such a waiver cannot be subject to tax. Subtopic: Basis of assessment. As earlier stated, the income tax year, which is called an assessment year, is the government financial or fiscal year. It runs from 1 January to 31 December of every year. It was from 1 April to 31 March, following up to 31 March 1980. A company's accounting year will be related to the government year in which the operating result of such company is to be assessed to tax. An accounting period which is related to any particular assessment year is usually referred to as the basis period. An accounting period which is related to any particular assessment year is usually referred to as the basis period of that assessment year. General rules for determining basis period of assessment are contained in Section 25 of SITA. The assessable profit of any company for each year of assessment shall be the profit of the year immediately preceding the assessment year. This is referred to as the preceding year basis of assessment. Assessable profit as defined in SITA is usually the accounting profit of the company as adjusted for tax purposes, that is, the adjusted profits that will be arrived at before reflecting the effect of any loss relief, balancing charge, or capital allowances. Where a company's accounting year coincides with the government fiscal year, that is the assessment year, it is the accounting year ending within the preceding government fiscal year that is taken as the preceding year. Where the accounting year of a company does not coincide with an assessment year, it is the profit of the accounting year ending on any day in the preceding assessment year that is taken to be the profit of the preceding assessment year. Illustration 6.3. Consider the case of two companies making up their yearly accounts, one to 31 December and the other to 30 September, respectively. The years of assessment and relevant basis period will be as follows. Assessment year, where accounts are made up to 31 December, where accounts are made up to 30 June. That should be 30 September. So for 2011, for the accounts that are made up to 31 December, the accounting year end will be 31 December 2010. For assessment year of 2012, the year end for the accounts that are made up to 31 December will be 31 December 2011. For assessment year of 2013, the year end will be 31 December 2012. Assessment year of 2014, the accounts for year end 31 December 2013 will be looked into. So that is what is meant by the preceding year basis. Note that in A, the basis period coincides with the preceding government fiscal year, since the accounting year of the company coincides with the government's accounting year. In B, the company's accounting year do not coincide with the government's accounting year. Nevertheless, each of the company's accounting year ending on a date in each of the preceding government's accounting year is used. This will be the position for as long as the companies continue to prepare their accounts to cover a period of 12 months ending on those dates. However, exemption to these rules are A. On commencement of a new trade, first 3 assessment years. B. On cessation of trade, last 2 assessment years. C. On a permanent change in accounting dates, the year of change and the 2 assessment year following. The applicable procedures are summarized below. New trade or business. First assessment year. Profit from date of commencement to the 31 December following. Second assessment year. Profit of the first 12 months of operation. Third assessment year. Profit of the preceding assessment year, that is the preceding year basis, if no 12-month accounts have been prepared to the end on a date in the preceding assessment year, the second year assessment is repeated as the assessment for the third year. For the fourth and subsequent years, the preceding year basis rule will apply. It should also be noted that election can be made by the taxpayer, that is the company, to have the assessment for the second and third year based on the actual results for those years. The manner of making this election and applicable time limit are the same for both personal and company taxation. Illustration 6.4. Kindly refer to your study pack. Cessation of trade or business. Year of cessation. Profit for the period 1 January to the date of cessation. Penultimate year. The assessment year before the year of cessation is termed the penultimate year. The assessment for this year, which would have been based on the preceding year basis, would be recomputed on actual year basis. If the amount accessible on actual basis is greater than that on preceding year basis, the inland revenue will opt to have the assessment for that year revised to actual year basis. It is to be noted that it is the revenue that has this option at cessation. The taxpayer's option is available at commencement. Where a company which has permanently ceased to carry on a trade or business subsequently receives or pays any sum which would have been included in or deducted from the profits of that trade or business, if it had been received or paid prior to the date of cessation, such sum is treated as having been received or paid on the date of cessation. A company ceasing permanently to carry on a trade shall not be deemed to derive assessable profit from such trade for the year of assessment following that in which the cessation occurs. Change of accounting period. When there is a change of accounting date, the revenue has power to compute as it deems fit the assessable profit for A, the year of assessment in which the change occurs, and B, the 2 years of assessment following. The assessable profit will be computed on the basis of the old and the new accounting dates for the 3 relevant years, and the revenue will decide on the alternative that produces higher assessable profit. Note that the preceding year rule is strictly observed throughout the computations. Illustration 6.5. Format Construction Nigeria Limited is an incorporated company in Nigeria with affiliates worldwide. It has been operating in Nigeria for many years and prepares its accounts to 31 December of every year. The controlling company for all the affiliates worldwide, which has its registered office in Sweden, had also been preparing its accounts to 31 December of every year until 1993, which when it decided at its revenue service meeting that all affiliated companies worldwide must submit copies of their 12 months audited accounts 2 months before 31 December of every year, beginning 1993. There are 2 alternatives the Revenue Service of Directors of Format Construction Nigeria Limited is considering: to prepare accounts for the year ending within 1994 to end in A, June 1994, or B, September 1994. As a tax consultant, your advice is sought so as to ascertain the financial year end that would minimize the assessable profit on which tax is payable for those periods. The following information were provided. Net profit per account for 12 months ended 31 December 1992, 200,000. For 1993, 500,000. For 1994, 600,000. 1995, 700,000. Other information in respect of the accounts for the year ended 31 December are as follows. Depreciation charged: 1992, 20,000. 1993, 50,000. 1994, 55,000. 1995, 70,000. Loss on sale of assets included for 1994 was 5,000. You are required to advise with supporting computation on the new accounting year end which the Nigerian company should adopt. Kindly see solution in your study pack. Explanatory notes. Irrespective of whether the accounting period is June or September, the revenues option will produce the higher assessable profit and shall be that based on a 31 December accounting date. Thus, whether the company prepares the account for the year ending within 1994 to end in June 1994 or September 1994 will have no effect on the assessable profit for the year of assessment involved, as it is the revenue that has the option to make the election.